So I'll go ahead and show you the 3-month chart now. July 11th is right here, and that's when we came out with the July presentation to warn everyone about the market sell-off. And the 14th would be the first day you would have to react to that. That would be the Monday. And we also basically mentioned that the 16,500 would be an area where more active investors would want to buy a new position, but only if they had sufficient cash. And by sufficient cash, we're not talking about 5% or 10%, a little more than 10%, right? And then more conservative investors would want to look to the 16,000, 16,200 range, right? And of course, that 16.5, we mentioned the 16.4 and the 16.6. Those are kind of the two upper and lower limits, right? So, turns out that was exactly what happened. The market actually bottomed in the middle of the lower aggressive range, and that would be the 16.4, and the upper conservative range, and that would be 16.2, right? And on August 8th, I reiterated that forecast, and I mentioned that worst case scenario at that time, the Dow had gone all the way back down to 16,364. Once again, it closed at 16,500. But I also mentioned worst case scenario in this trading cycle would be 16,000. So in other words, what that meant was that for things to occur outside of what I would feel to be under the normal circumstances, in other words, for unforeseen events to occur, the worst case scenario would have been 16,000. So in other words, don't even worry. We've been having people talk about correction, sell-off, collapse, 20, 30, 40% all year, right? Last year as well. This was nothing. This is less than a 5% sell-off. No big deal. In the August forecast, I mentioned that if we did get a quick rally back up to around 17,000, you should sell that position, right? You should sell that new position that you bought right around here, only if we got a quick rally. And we did get a quick rally. Within a week, maybe 6 trading days, we got back up to 17,000. And what have we done since that time? Well, we've stalled. Right? So that means those of you who did not sell this new position that you bought after this retracement or correction, whatever you want to call it, if you didn't sell once it came back up here, then you risked money in the market for no reason. It stalled up to 17,000. Why? Because the market is uncertain. So the call that I made was correct, and it was prudent. Even if the market goes up from here, it was still a correct call, because the market did stop and pause at around 17,000. Now that's not to say that you should have sold everything, just that new position. Okay, I mentioned that in the opening statement. I believe part 3, I talked about the velocity of money or velocity of the trade. So as it would turn out, based upon recent developments, I think the market is going to go higher. It doesn't mean that this correction period isn't over. Right? We may have another correction, but I think that's going to be limited. I think that the downside for another correction over the next few weeks, I don't know if I could say up to 2 months, but 1 month for sure, maybe 5 to 6 weeks from now, I think the downside on that is going to be 16,500, 16,600, and probably 16,600. Okay, those two, right around that range. Right? I don't think we're going to retest the 16,333. But the bottom line is that Europe continues to get worse, as I've been talking about quite a while, right? You hear now more problems with deflation. And, I mentioned in a video last year how I wrote about that 4 years ago. They didn't react at that time by enough. And so now they're faced with a situation which I don't know if they can get out of it. I don't think they can. And of course, recently, I believe on the 4th of September, the ECB did announce what I've been talking about for several months now. I think I even mentioned it last year, that they would be purchasing certain assets from the banks. So they are doing that as a forecast. And as a result of that, what's happening? Well, the euro is collapsing. And I also talked about this in part 1 of the September issue, in the opening statement, and I think also in the US dollar euro section. We talked about how this has been like one of the easiest trades you could ever imagine, right? Was the weakening of the euro. And it's continuing to weaken. So because of the weakening momentum of the EU, and because of the lowering of interest rates and the asset purchasing program that they've announced in the EU, because of the continuing threat of inflation, I think that money might actually start to rush back into the U.S. market, which could boost the market soon. Okay, this is a continuation of the U.S. stock market forecast. Of course, last week of September 5th, I released a kind of a preliminary forecast, and I mentioned that I would release another one the following week. So this is covering from the data up through September 12th, Friday. And once again, if you're not active, I wouldn't even be worried about this potential downside. Okay, and even if you're active, I certainly wouldn't be shorting the market looking for downside. I think that's ridiculous to pull such a move, because you've got overall fundamental strength in earnings in the U.S. economy. So I do think that there's going to be further upside. 17,500 I think is in the cards, and that could come sooner than we expect. I think that we could get a sell-off, but I don't think it's going to be that substantial. I think we're looking at 16.6, 16.5 at worst. Although other lower levels are possible, but this is what I feel to be the highest probability based upon what I see today. And remember, you want to be managing your positions. You want to be generating that cash.